For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. Trader Stacey Burke from Stacey Burke Trading. Today we're going to be reviewing the weekly setups. We're going to look at the templates, and we're going to be talking about how to identify the best trade setups based on how the week closes from the week before and how the week opens. So straight away we want to know, did the week close up or down? Did it close as an up candle, a down candle, inside of the previous week's range? Was it trading range, trending week 1, week 2 in terms of moving higher or lower? And we'll look at that, and then we want to know, where is the low and the high of the week when we start? And on Monday, what happens? And so we want to know, is there a false break continuation on Monday for a reversal or a trend trade? Or does Monday break out of one of those boundaries from the previous day, from Friday, and potentially a weekly boundary as well? That will give us a thesis, if we don't already have one, based on how the week closes and the behavior of Friday itself. Now, I received a lot of questions, and traders still confused a bit about the day count. Some traders don't see the point or the meaning of any of the day count and think that it's worthless. And as I mentioned to one trader, if you don't understand the day count and you don't understand 3 levels of rise or fall, one trader mentioned to me he saw it was totally irrelevant and subjective. Totally disagree. It's not subjective. The market moves in increments depending on the instrument that you're trading. It could be 25, 25, and 25. It may be 50, 50, and 50. And on certain days, it may be 100, 100, and 100. And if you don't understand the levels of rise or fall, you definitely don't understand the power of the best trade setups, because those 3 levels of rise or fall are what builds the order flow for an explosive vertical move. And those are the trades where you can make a lot of money. So if you're just trading these little moves and you're in the retail mindset of getting in the right direction and getting pips, as opposed to waiting for the market to trap traders in one direction, and even the type of price action that generates that order flow is easily recognizable, meaning that there's vertical moves and then there's escalator type moves that go back and forth, back and forth, back and forth. And those are the movements that generate order flow for explosive vertical movements. The explosive vertical movements are where you have the opportunity, potentially, assuming there's no news that generates that catalyst, for explosive vertical moves where you can size into where a market is going to explode or collapse. And that is where you have 5-star setups. Like I think that traders are still, as much as they think, they talk about smart money concepts and other people's trading concepts and all these things. And as I keep reiterating, all of that's great. But unless you can go to the screen with simple, reproducible, scalable trading setups that are rinse and repeat, that show up every single week, you're going to keep chasing this false belief that one day you'll discover the holy grail of trading, when in reality it's about understanding scalable trade setups. And I get this negative feedback from people that email me and stuff, and they're the 1 or 2 dislikes, and I always laugh, because if you're that grounded in your thought process, you're obviously not making money, because traders that are making money are open to learning all the time because they want to make more money. And as I keep reinforcing scalable trade setups, stepping back, letting the market set up, generating the larger, bigger picture movements, the ones that are going to explode, the ones that trap traders, at specific times and then move explosively because they have traders caught up high or down low and they're not coming back. And traders will try and counter trend those moves. That is where traders will blow their accounts out. The days where they're not coming back, they will try to counter trend them and they'll hold on to that and they'll average into that and they'll do all kinds of irrational, impulsive. The impulsive, irrational behavior is because you're trying to trade movements in the market as opposed to understanding what trading setups are that happen based on day 1, day 2, day 3, 3-day setups, 3-session setups, the timings and levels of these trades. So when a trader said to me yesterday, I think the 3 levels is subjective, I have to ask you, what is it that you are actually doing at the screen if you cannot understand 3 levels of rise or fall? Whether you get that exactly to the pip or not is irrelevant. It's understanding the psychology behind what that does to the market and how that sets up for explosive moves. So when the market explodes and traders say to me, that's because the market didn't like this news release. You have to be kidding me. You actually think that that's related to that movement in the market? It has nothing to do with it. The object of the market is to take money from the many and transfer it to the few. It has nothing to do with the news. It has nothing to do with, what somebody Biden said on his news release. They will use that as an excuse to move the market violently. And traders who trade the news, who one trader mentioned to me the other day, had massive slippage on the news. I repeat, I do not trade the news. And the reason for that is for that very reason. Even if I'm right, they will have slippage on your fills because they can get away with it at those particular times, saying that there was no other orders in the market. Good luck checking that or fighting that. They can do whatever they want. Trade when the circumstances are normal and you have the opportunity to play on what is, as best can be called, a level playing field. So coming back to what we're talking about today, weekly templates. So when the week ends, first question I ask myself is, did the week close up or down? On Friday, the market closed down. We'll just make this bigger so everybody can see. We'll make it nice and red. Market closed down on Friday. This pink line is our weekly separator. So the market opened up on Monday morning. Over here, this is gold. We'll look at some other pairs. Market opens up on Monday morning, breaks down. Now we can start with this week. It breaks down first and triggers the low of the week. I said in that first slide, where is the high and the low? The high was on Thursday and the low was on Monday. The market traded down on Friday before continuing that move down into triggering breakouts at Monday's open. So again, understanding that when the market breaks down, we immediately have shorts into the market. We have short traders triggered into the market, breakout traders, whatever you want to call them. They're in the market. And those traders most likely have stops roughly at the high of the day. So my initial thesis when I see a market break a low or a high on a Monday is this. We see a market break out on a Monday. Now I want to know, does the market continue to trade lower on Monday? Or does it break out and pull back? Because now I know that we have breakout traders trapped at the beginning of the week. One of the trades that I look for is a false break, whether it's a Friday, we could have Monday inside, and on Tuesday, we break the high of Monday. Now, this is day one. That could be Friday, Monday, day 2, day 3 on Tuesday. This itself is a setup. If the market closed down in a downward moving market. Now, if this market was to open on a Monday and trigger that low, and this was the high of the previous week, we have day one pulling back inside, closing, and we may have Tuesday now opening up, and we have Tuesday triggering the breakout of the high of Monday. So we have our high of the previous week. We've triggered breakout traders. I said that Monday, Tuesday form our initial balance. We can still get a Monday, Tuesday trade that follows through again. Maybe it'll be Asia, London, New York for a continuation of a trend. So again, that's the market's going down. It closes down. This is the continuation after breaking the high of Monday's bar. Now this comes back to understanding three things that markets do. They break out, they pull back, and they trend. We get rid of the underline here. Oops. They break out, they pull back, and they reverse. Call that a false break. Or they break out or don't break out, and they trade back and forth in a trading range. And I repeat this over and over again. That is the only three things that markets do. So when you understand that, again, tying in our weekly templates, we can form our thesis based on setups on how this market potentially may be setting up for the week. So again, coming back to Monday. If Monday's inside, I do nothing. So if I want to see the break of a high or low first, we might get a break of Monday's low on Tuesday, on day two. And this is where some of the confusion happens for traders. We could have a Friday level, Monday's inside bar. On the new week, traders have gotten confused. Monday is the first day of the week. But this break of Monday's low is the first day for breakout traders who are going short in the market. Day one shorts. We could have this market come back up, trade back up, maybe even go higher on Wednesday, and break down again on Thursday. And Thursday's breakout is day two shorts. Day one was Tuesday. They came back inside on Wednesday. Didn't break the high until Thursday. Broke down, took it out. We have day two shorts. We could see a day three short on Friday for an explosive reversal trade and a 1, 2, 3 at the low of the week, which is formed on Tuesday. So these are the different scenarios that as we head into the new week, we can look to identify. So coming back to the whole point of this. False break on the Monday. We'll just do this. Get our false break. Tuesday, maybe Wednesday. These are the big moves. 1, 2, 3. This might be Monday, Tuesday, Wednesday for the vertical move. Escalator up, elevator down. So when traders say to me, oh, there isn't 3 levels of rise, or what's the importance of the day count? If you don't understand the 3 levels of rise or fall, or the day count, or the types of templates, this trade right here means nothing to you. You'll trade that the same size as you do these little swings in the market. You'll get this swing for 25, or maybe this swing for 25, and you'll miss out on this trade for 150, where you could add size in. as this market's starting to accelerate and collapse, knowing that they aren't coming back. Same thing can happen on the downside. Market could have a false break, come back up, work into the low, break structure, and go up after we have the 1, 2, 1, 2, and 3. So these are the types of trades that traders can learn from these templates. Again, you've heard me repeat a phrase that was mentioned to me: size the best and scalp the rest. So we have our session trades. These might be early on in the picture, or they're part of the 3-day setup. But when we get a 3-day setup where the market has coiled volume, trapped it down low, or again, we'll look at some examples. We might see the market even go up higher, trap volume, hold it up there, and come back all the way down, as we saw in Swiss franc, Canadian dollar, 400 plus pips moves, where again, 3 levels, 3 weeks, false break beginning of the week, and then a 3-day setup with 3 pushes culminating into the high of the week. So let's look at some specific examples. So again, we have the false break on the Monday on gold. I've talked about initial balance Monday, Tuesday. Typically, we'll establish the high and the low of the week. I talked about going 25 to 50 pips outside of the 100 pip box. A few traders emailed me that, told me they thought that was rubbish. I don't care what you think. It makes me a lot of money, so I'm going to continue to do that. So the other side of the coin is this: if you are patient and understand the levels of rise and fall, and you understand the importance of Monday, Tuesday setting up, then you can identify larger capitulation style type trades in your session. It may be, if you're trading Asia, there may be a high of the week, high of the day opportunity, low of the week, low of the day opportunity in Asia because of the day 1, day 2, day 3 setup. It may be a day 4 trade after the reversal. We'll look at that. So false break, beginning of the week, trigger shorts, they go vertical. Now we're looking for the day 2 long. Day 2 long, because the market reversed. It doesn't give us that. It does not break the high of Monday. What does it do? It breaks down, pulls back, and continues to fall, giving a U.S. session trade on the Tuesday on day 2 trend day. Day 2 trend day, this is the reversal inside. We've reviewed that trade setup before. It breaks down inside, pops up and rolls over. It doesn't break the high. There are no day 1 longs in the market. No daily high is broken. No daily high broken means there are no day 1 longs in the market. This is an intraday high that is broken. What does the market do? It comes down and goes sideways. When a market goes sideways underneath of the high, it's going to explode vertically. When a market goes sideways above the low without taking it out, it's going to explode vertically. Replay that and listen to what I just said. That alone will give you the understanding of when you know you can size into a trade. Peak formation above the low. Peak formation above the low heading into the London session. That is not the low. Monday is the low. Coiling sideways, peak formation to the high of the day. That's a scalable trade setup. Day 3, peak formation up in a downward trending market. The buy low scenario for the US session. Vertical stop hunt, the W, double bottom reversal into the breakout traders to continue that move down. Day 1, day 2, day 3, trend trade back in line with the downward trend. Now we talked about the exception for this is non-farm payrolls. Typically this is something that you can see on a non-farm payrolls week, a 4-day setup. 4-day setup. They reverse it on the Friday. Notice the last leg down. You're selling down low into the lower 100 pip box after 4 days down. Tuesday, Wednesday, Thursday from Monday's high. 4 days down on a non-farm payrolls Friday. This back and forth price action is a dead giveaway that this is order flow for a reversal trade setup. Coming back to starting the week closes down. The week closes down. We have a holiday on Monday, an American holiday on a Monday or a Friday. Write this down. An American holiday on a Monday or a Friday will lead to big moves in the next week. A holiday on a Monday or a Friday in the U.S. will lead to big moves that week. So coming back to peak formation low on the Thursday, there's the low of our week. That is the low of our week. Monday is an inside bar. It's a holiday. We talked about this the other day. The market breaks out. I've put the darker blue lines on so that traders can see this. The market breaks out. What we want to see is a 3-day setup. The peak formation low, day 1, day 2, no break in structure. We have day 1 longs triggered on Friday, day 2 longs on Tuesday. This is an inside bar. Day 2 longs triggered on Tuesday. Inside bar traders triggered on Tuesday. We know, as we talked about the other day, this was a high of the day trade in London. This is the half Batman formation. Peak formation, lower double top inside, half Batman for the short trade, and then the low-hanging fruit trade in the U.S. session. Day 1, day 2, day 3, inside bar Monday. Inside bar traders are caught. Okay, false break. We have volume caught down underneath. So the last daily low that was broken was on Thursday. This volume goes lower and traps below the double zeros. Trap volume, day 1, day 2, break, inside bar, day 3, for the sell high setup. Okay, now we have our new high of the week, and we start the same process down. False break on the upside. Okay, inside of the range, false break on the downside. Peak formation high, peak formation low. High of the week, low of the week. Breaks structure inside. Breaks structure inside. We talked about 3 levels of drop, 100, 100, and 100. False break, reversal, pulls back to the bottom of the 100 pip box at the New York Open. So again, notice volume gets trapped below the previous day's low. The market goes vertical. We talked about the high of the day trade yesterday in the US session after it takes out the London session high and the high of the week. Trap volume gets 50 pips plus put into them, and that gets the breakout trader from the US session on Wednesday. Okay, so coming back to some simple understandings again about locking in the money, not holding on for 500 pips for 5 days because they're going to come back and get you. Take the trade, lock in the money, and get off the screen. So the template is this. Day 1, day 2, day 3. Friday, in this particular case, Thursday puts the low in. Friday triggers day 1 longs, inside bar on Monday, day 2 longs on Tuesday. This is the second day that breakout traders are triggered into the market. So we're going to look at some other examples, but I want you to understand when a market starts, we have our Monday. Okay, that's the first day of the week. You could not do anything and just start on Monday, but there's no border broken on Monday. We don't touch this. Forget that it was a holiday. It's inside. It breaks out on Tuesday. Now we have our 3-day cycle. Day 1 longs. Day 1 longs. Day 2 longs. I've talked about this. Day 2, your odds for a successful reversal trade increase 70 to 80%. Day 1, you're trying to reverse this. You might get a 25 pip move, but day 1's potentially, in most cases, may be the initial breakout trade. Day 2 longs now, we may have volume caught up high for at least a 50 to 75 or 100 pip move, depending on the instrument. False break. Wednesday, false break reversal, explosive 3-session, 3-day squeeze setup. Day 3 trades. So day 1, day 2, they may move in any session. Asia, London, New York. I come to the screen, New York. It's already in process. We've already locked in the high. This is a low-hanging fruit continuation trade. Day 3 trades. Again, write this down. Day 3 trades or level 3 trades will typically move in New York. And why is that? In most cases, we have 3 sessions setting that up on the 3rd level. Repeat. 3 sessions setting up that trade on the 3rd level. A New York session reversal trade. 1, 2, 3 on the 3rd level. Level 1 starts to move down. Level 2 is the inside. Level 3 breaks the low. Asia, London, New York, short squeeze, explosive move. Asia puts in the low. Level 1. Level 2 is New York into the new day. Level 3 breaks out and gives us a New York session trade at the high of the week on level 3. Level 1, level 2, level 3. Now, I know there's traders out there right now who are saying, well, that's more than 75 pips. You're right, it's 300 pips. 50 to 50, or 25 to 25, 25 to 25, and 25 to 25. Yes, it's more than 300, but that's 3 100 pip level boxes. Take off the peak formation and count them again. From 50 to 50. 100, 200, 300 pips. That's 3 levels of rise to the low of the week to the high of the week. New York session trade. On the 3rd level, 3 sessions will set that up. 1, 2, 3 to the high, 1, 2, 3 to the low. Short squeeze, peak formation, high of the day, high of the week trade for the short trade. The market comes down in 3 pushes, and we get the explosive reversal trade inside. 3 pushes and the reversal trade back inside. The giveaway, the break of the middle structure right at the first candle of the opening of the Asia 12 candle window. Okay, pin hammer. So for savvy traders, I know there's lots of people who are out there already saying, oh, this is all great in hindsight, but I'm going to tell you this, and I want you to listen closely. It's going to happen again and again and again. And you're going to probably miss it next time because you don't have a process to identify the best trade setups. And one of the easiest things that you can do to do that is understand when a level is broken. Weekly high, weekly low, daily high, daily low. What is the day count? How many levels of rise and fall? It is important if you understand the power of these collapsing vertical setups and explosive vertical moves out of squeezes. We go up to the previous high of the day, high of the week. Not only does it go up there, 3 levels from 100, 25, 50, and 75. What do? They hold it there. And which trade is this? This is the 7 o'clock New York time vertical move. Okay. What that is when they hold it up there for an extended period of time, the hour prior to the 12 candle window, specifically 30 to 45 minutes into that hour, is when that market has the potential to collapse into the open of the U.S. session. This is the end of the London session into the open of New York. That's the 7 o'clock vertical move up on level 3. So nobody, I get emails from traders and they say, oh, this is so-and-so and this is that. Listen, there's time of day. Markets trade at certain times of day. That's not new. Nobody thought of that. They've been doing that for 100 years. These numbers are the price. That's not new either. Nobody thought of that. That's always been there. 3 levels of rise and fall. Just think simple. Think really simple for a sec. I want you to think of something really simple. We're going to bring everybody up high and get traders to hold it up there. They're going to buy up there or sell up there, one or the other. They're up high. All their indicators are telling them it's a trend. Guess what? That's called trapped volume. No, I'm sorry. There's been lots of traders doing this for over 100 years. Your guru didn't just think of that. It's not his concept or her concept. It is what it is. It's numbers, price, and time. We want to sell high and we want to buy low. It's as simple as that. I cannot emphasize that anymore. If you're in the trend trade inside, this is a trend trade. 1 push, 2 push, 3 pushes. This is a short squeeze vertical move for a long trend back to the high of the day. Remember what we talk about. Where is the money? The big money. The big money has all the time frame traders in the market. Okay? Daily, 4 hour, weekly. You break a weekly level, guess what? There's money there. It's as simple as that. And then when you get into a trade like this at level 3, 15 minutes before the US session opens, don't be scared to hold on to that. They're not going to let this guy out without taking a loss. They're not just going to give him a kiss. They're going to blow right through this. Why? Because this guy's in the money from Asia. Okay, once they get him, maybe they're going to pull back and get the guy who shorted it into the open of the US session that just came along and saw this collapsing, and he didn't lock in the money. Lock in the money. Get off the screen. Don't worry about trying to catch the counter trend move or anything else. Pay attention up here. If you're into the US Open and this collapses and you get 50 pips and you get into this level 1, right? Level 1 in the lower 100 pip box, take the money. Get off the screen. Okay, so we can look at West Texas. I know some traders' numbers might be a little different. Each platform is different. I talked about major quarter levels on oil, NASDAQ, S&P, and gold. I use that as well, but depends on the setup. If there's a setup right off the bat, then I'll just use my 100 pip boxes. So as one trader said, it's very subjective because some instruments are, move 500 pips and 300 and as opposed to 25. And understand, you should be able to tell how far something's moved in a day. So if it's moved 400 pips, it's obviously moving in 100 pip increments. If it's moved 50 pips, it's moving in 25 pip increments. If you're trading the NASDAQ or S&P or oil, and it's moved 400 pips, you are still in a 100 pip box when the session opens. So you should have a thesis. What I have emphasized over and over again is pay attention. The highs and lows, okay? The highs and lows of the day, okay? Highs and lows of the day are relevant, okay? The market trades around those levels, but those levels will coincide with major round numbers. What that means is that, okay, here's the low of the day. The low of the day is here, but it's inside of this box, which means that if they come back up and they go back to that low, guess where they're going? They're going to go at least to there. If they go lower, guess what? They may end up going down to the next box or even through that. So let's look at oil. We had, again, the Monday is your gift. This was the third day of the month, the first day of the trading week. And what does it do? It breaks the high of the previous day. Okay, it breaks the high of Friday and reverses. Now we have our false break. We have our false break. We want to put in our anchor point. Day 1, day 2's inside, day 3 breaks the high. False break, Where's our target? You said it. Where is the money? That's the setup. When they go and break out on the opposite side and fail, now I want to see first red day, 3 peaks, whatever that may be. We get a high of the day sell opportunity with volume trapped up high on day 2. This is up high in the box, right? We're in a 250 pip box. If it falls through that low of Asia, it's got space to the first major quarter level. It has space all the way down to the low of the day from the Friday, and it has space all the way down to the low of the week from Thursday, and it has space down to the next major quarter level, which is over another 250 pips. So we're talking about almost 500 pip move. So if you understand the day count, day 1, day 2, day 3, false break. Remember, we talked about 3 things that markets do. And then we have a high of the day in Asia, a retest engulfment, London Open, for an explosive vertical move. You don't make a lot of money trying to trade these little swings back and forth inside. You make a lot of money by identifying these trade setups, positioning yourself in the market with a 1 bar stop up high for an explosive move back down to the low of the previous day and previous week. These are 5-star trading setups. Now, when day 2 closes on oil, so coming back to what we talked about first, we'll just go back and look at this. Did the market close up or down on that Friday? Okay, we have our Monday open, and we have our Friday close. We'll make that red. Okay, so we have our Friday close. We start the week fresh again. We don't know anything. We just know that the week closed down. And by the way, that was 3 weeks to the high the previous week. 3 weeks to the high, and we broke down inside. And we just, well, look at it. It's a very similar pattern. Isn't that interesting? Day 1, day 2, high of the week, high of the month. We'll talk about that later. 3 levels of rise and fall don't really matter, do they? So we're in a broken down market. It closed down. They triggered the low of the week before reversing. So you'll notice breakout traders, if they did trade that, they've just gone far enough to hit stops, but not necessarily trigger breakouts. But anybody who did sell down low got caught. That low forms our day 1, day 2, day 3 to the high, breakdown, pull back for the collapse. And that gives us, guess what that gives us on day 2? That gives us our first red day. Isn't that interesting? First red day. First red day makes a peak formation before collapsing. That is our first red day. And we have volume. Remember what I said a first red day does. It traps volume all above that area. So again, coming back to major quarters, we would like to see that volume stay trapped above that major quarter level. That coincides with our peak formations up. Peak formations up without taking out the low of the previous week. A market that goes sideways, breaks down, and pulls back up to the high from the US session into the major quarter level. Peak formation stop hunt. The A top. Same as day 2. The A top. Vertical move up into the high of the day. Vertical move up into the high of the day. Into the major quarter levels. High bull candle. Gets trapped. Heading into the US session. Stop hunt. We broke down first, triggered breakout traders. Okay. Remember what I said about the major quarters. They go up 250 pips. Hit the high of the day before breaking down. this market has the potential to do a measured move, which is one full expansion at least of the range. First red day trade, we want a peak formation selling high. Market breaks down heading into the US. You do not want to counter trend this trade. Remember, the week closed down. We went up first and triggered a false break on the Monday. Day 1, day 2 shorts. Day 3 shorts. Okay, so first day of short breakout traders is on day 2, which is Tuesday. Shorts are in the market. They trigger the breakout right away on Wednesday. Go vertical into the high of the day, and then the continuation trade. Day 3 now, so I said initially Monday, Tuesday puts in our high and low of the week. Day 1, day 2, day 3 down. This could be our low of the week. We've dropped 3 levels. Okay, 250, 250, 250. That's 3 levels of drop. We're in level 1 in the 1,000 pip box. They've gone through the quarter level though and put a low in. Well, let's see how that low holds up. Lo and behold, at the end of our 12 candle window, we get an engulfment and pin hammer at the low of the week. Low of the week engulfing that lower structure. Low bear. Market breaks back up and pulls back above the quarter. 1, 2, 3 pin hammer at the beginning of the US 12 candle window, half hour mark, for a 100 pip explosive move back up. That's our break in structure inside. That's inside. It's not a break of structure on the daily count. It's a break of structure on the inside. Because remember, no breaks of any daily highs have been made. Market trades higher before pulling back and continuing on Friday. You'll notice the market goes down and trades into the peak formation low. Okay, this is the sideways price action inside of the peak formation for the continuation of the long trade, and an ascending triangle on the Friday after locking in the low of the week. Trap volume down low, 3 pushes, explosive move, break of structure inside, the trend trade on day 2 off the short reversal, Friday, the end of the week. So hopefully this makes sense. Okay, so every time a breakout of a daily level occurs, you have either day 1 shorts, day 2 shorts, day 3 shorts. If you get to day 3 of breakout traders, the end is potentially near. Day 2, again, we get breakout traders in the market on day 2, but this was our day 2 continuation breakout traders. Then they pull back and go vertical to the high of the day for the peak formation trade into the open of the US session and the measured move. Measured move is a trade where you're entering in prior to it taking out that low. That peak formation now, this box has the potential for at least 1 full range expansion, if not 2, depending on how that market trades. So, false break, beginning of the week, triggers breakout traders in the wrong direction. In this particular case, the trend was down, the week closed down. False break was up for the continuation trades back down. Peak formation high, short trade. First red day, peak formation high, short trade. Large, scalable, massive trade setups. Look at the euro, and then we'll let you do some homework. Okay, I talked about 25 pips outside of the box, false break, but that begins our march up. Day 1 inside triggered the low of the week from the previous week. Okay, we had a peak formation high on the Friday, but no daily high broken. So we have day 1 shorts in the market, but it reverses back inside on day 2 and breaks the high of day 1. So we have volume trapped at Friday's low on day 1. They break out on day 2 to the upside. So they trigger shorts. I'll come back and actually just go back and look at this. We have a week that's closed above the open, but we're effectively in a trading range. What that means is that we're still trading inside of the previous week's high and low when the week starts. They break out. We have a false break as it's pulled back inside, closes inside. There's our false break. In a trading range, we're inside of the high and low of the week. The market breaks the high of Monday. And you heard me say earlier, day one, we don't want to, day one breakout trades, we don't want to counter trend that. So we have a breakout of the weekly low. The market then makes a peak formation high in Asia on day two after breaking the high and gives a sell high setup on day two on the first day of breakout traders long. So we have a false break on the long side. Monday, Tuesday forms our initial high and low of the week. One of those extremes may tend to hold for the rest of the week. Market trades back down on day two into the low of the week before pulling back. Day three, Wednesday, trades into the low below the 00 box. Okay, so again, one push. Okay, we had our low of the week on Monday. Goes up and makes a high. Sells down to the low of the week. One push, two pushes, break in structure. Break in structure is back inside, taking out the low-hanging fruit. That's the break in structure on the inside of the 100 pip box, auctioning down into the low of the week at the open of the US 12 candle window. Do you notice that this bull candle closes above that box and trap volume? Short squeeze for the explosive 100 pip move back up. Day three. Day three, okay, trap volume down low. Low of the week, Monday, Tuesday, establishes 80% of the time the high and low for the week. One of those extremes may tend to hold. We're 25 pips below the 00 box. They've traded down into level one, down into level one, down into level one, explosive short squeeze. We get a trading range. Market trades right to the open of the US session to the high of the day for a 50 pip move down through the low-hanging fruit, which is caught up high, moved it up, held it up there. They held it up there, and there's space underneath. Doesn't have to go all the way down, but they'll go down into traders who are in the money. One push, two pushes, three pushes, and a reversal into the close of the session. Okay, so they've trapped volume down low in that lower quarter, gone vertical and sideways. This is the parabolic setup heading into the new day. What that means is this sideways price action is going to go vertical on day 5. They've already come out of the low of the week on a short squeeze. They're going to go at a minimum, right? They've already gone up that high. They're going to a minimum possibly of the high of the previous week. And in this particular case, we've got room all the way up, which they did. They went up into the 100 pip box to the third level again, 3 levels of rise, 1, 2, 3, and kept going. Found resistance at the 00s before breaking down, heading into the US session and going into consolidation for the remainder of today. So, coming back to the thesis, false break. We had a false break on the Monday. It traded up and put in a high of the week on Tuesday, and they traded down from level 375, down into the low of the week. Day 2, 1 push, 2 pushes, 3 pushes on day 3. You heard me say New York will often be the 3-day session trade entry, because on the 3rd day they will go 1, 2, 3, Asia, London, New York. So go into your homework, mark your charts off, study the Mondays. Does it break a level? If it's inside, has there already been a peak formation formed at the end of the previous week? False break. Could be a false break on Friday in a trend direction going down, false break on a Monday, reversing to continue with the trend on day 2. Day 2, level 2 trend trade. So hopefully you got some value from today's video. That's a long-winded, but I think very in-depth explanation of weekly templates. You need to mark your charts and understand these day counts for the session trades and the 3-level 5-star scalable explosive trade opportunities where you have the potential to scale in and make a lot of money. Have a great weekend, traders. It's been a big week, and may the markets go with you.